Okay, so in this video, I'm going to talk about the Augusta rule. This is not the TikTok version, okay? So what that means is this is not just the headline. We're going to actually discuss the statute. We're going to go over a case on how this actually works and go through some of the takeaways that I think you should have when you're doing the Augusta rule. You want to actually implement it properly so you don't end up like the individuals in this court case. So I'm Jasmine DiLucci. I'm a tax attorney, CPA, and enrolled agent. And of course, I work with taxpayers on tax planning, tax resolution, tax returns, and accounting, all of that. So let's get into it. So on the screen here is the Augusta rule. So it is quite literally this section here. If you want to know the code section, it's IRC 280 capital A and then subsection G, right? So that's here. Okay, so this is that whole section where it also talks about like home office expense, and then that final section is the Augusta rule. So I'll recap what it is in case you're not already familiar or you would like a reminder, which is there's this exception here, right? So if we read it, it basically says if you rent what you're using as a personal residence for 15 days, well, for less than 15 days, so 14 days or less, to anyone, then it is not income. It's basically not recognized as taxable income. And so what people do as the loophole, where we call it this Augusta loophole, is you, of course, are the person on both sides of the party. You're both parties. So you are both the business that is renting from the home, so then you get the deduction on your business and you don't have to recognize the income personally. Right, so that's the best of both worlds. Those are always the type of transactions we're looking to have. Now, this is a related party transaction. And if you're not already aware of this in any circumstance, because there's lots of circumstances where there are related party transactions, they are under high scrutiny, right? So you already need to have support when it comes to the IRS, just like with any deduction. But a normal deduction where you went to Office Depot and bought something for $30 is not under high scrutiny versus something where you are literally paying yourself tax-free money is under high scrutiny because you are both sides of the transaction, okay? So this is no exception. It's going to really need support. And that's really going to be the main point of this video, which is going to come down to the implementation of the Augusta rule is really the issue that people have, okay? Because they go and do it themselves. They listen to the TikTok, whatever it is, or they just kind of hear about the rule from a CPA. They think they've got everything they need, and they just kind of plug away from there. The hard part about this is not the tax law. It's pretty straightforward. We really have this statute. In this case, for this type of tax law, we really don't have much more guidance, right? Typical tax law, we might have a lot of treasury regulations telling us exactly how and what to do. This is as straightforward as it gets. So we do still have court cases being people implementing the rule, and then we see how it turns out for them. And so that being said, we don't have a ton of court cases for this specific section. It's getting more and more popular now, so I'm going to expect in many future years we're going to start seeing a lot more court cases. But for now, I've pulled a very recent one that just came out that I think is a really good example of how people get a little bit they're just not implementing it correctly. That's what it is. So this is a 2023 tax court memo. So what that means is, of course, that it came out in 2023, and a tax court memo is basically like, this is not new law. This is old hat. This is not a novel concept. This is not interesting, new. We're just reiterating the established and clear law here. And so let's go down. I've highlighted some sections for it. So the tax year is 2015, 2016, and 2017. And I want to point this out because this is exactly how this works every single time we're in tax court, which is you're not going to be in tax court close in time to the tax years at hand. So the IRS almost always audits 3 years out. So this was probably picked up around 2018 and worked with the revenue agent. And then, of course, they probably picked up 2 more years after seeing that there was potentially an issue here with the rent expense for the Augusta rule. And then basically to go through all of the different sections, it takes time. And so they went through the appeals process after working with the revenue agent for a while. They went through appeals. Appeals was like, no, I don't think so. Then they went to tax court, But you don't just get thrown into court. You actually first will negotiate with tax counsel, right? The tax attorneys for the IRS, which it really is the level where you can start meeting in the middle. A lot of times the tax attorneys, if you have a decent argument, they will say, okay, well, they have this thing called hazards of litigation. So they say, well, it's a risk to go to tax court, plus it's more resources, more time. We are incentivized and need to settle here. So the fact that that didn't happen and we're still going to tax court already tells you how bad their position was and that we actually made it this far. And the statistics, once you get to tax court, you are going to lose. That is the statistic. If you are reading a tax court opinion, the taxpayer almost certainly lost. There are, of course, exceptions, but they are rare, especially nowadays. Okay, so in this case, we've got 3 doctors, and they also own a Planet Fitness. And so this is related to the Planet Fitness that they have together. That's their business, and that is the thing that they're having board meetings about, that they use each of their personal homes and essentially distribute rent checks to each of them to distribute tax-free, or hopefully to distribute tax-free payments under the Augusta rule. So that was their plan. That's what they figured out. And so I highlighted some relevant sections here where they basically started doing that in 2015. And let's see. So the main thing, and the first thing that always gets mentioned in tax court, is basically that there wasn't significant enough proof, right? So they failed to produce credible. That doesn't mean they didn't produce evidence, but they didn't produce evidence that the tax court viewed as credible for what was conducted at such meetings, and their testimony was vague and unconvincing. And so what ends up happening, the most credible evidence for tax court, for the IRS, is contemporaneous. Okay, so what that means is literally in real time. So it is very likely or possible that they came up with kind of a reconfiguration of these meetings and what happened. But again, they're getting audited so many years later. So they're having to look back 3, 4, 5 years, 6 years, or by the time this 2023 came out, it was even longer. And they're trying to figure out what happened at these meetings. And of course, it's not a surprise that they weren't all on the same page. They didn't have as good or as detailed of documentation. And so they did not convince the tax court or the IRS examiner. Okay, and then of course, they did not obtain an appraisal of the rental values. I think the court mentions that because of the high rental value that they chose. I don't think in most scenarios you'd be expected to get an appraisal, but if you are in a situation where you are kind of coming up with a number that is very high, maybe there's a reason, right? It could be you're in just that best location ever, and maybe you're renting it on the weekend where there's a big tournament or big game in town. That could be a scenario where you may say, maybe I need to get some additional support for this because the number is so high. But your typical person, it's going to be a regular house in an area where there's clear fair market value comparatives. And what happened here is that, of course, they began paying themselves $3,000 in monthly rent to each. So to reframe, right, $3,000 doesn't sound crazy when you think about it for a 30-day stay. Remember, this has to be 14 days or less. So what they are claiming is $3,000 for 1 day per home. So I don't know about you, but just on its face, I wouldn't pay $3,000 to rent a room in someone's home for a day, no matter the location, but especially probably in Mississippi, which is where these guys live, or at least I think it's Mississippi. So that's essentially, that's your first test. And I think another way to look at it too is if they could rent it for $3,000 a day, they probably would rent it for $3,000 a day, right? If almost most people for a regular home, if you could rent a room in your home for $3,000 a day, you would just rent it out and make an extra $1 million. And so that's another thing to look at as well. All right, so what happens? Well, in practice, of course, the revenue agent picks up the case, and there's almost no revenue agent that's going to look at that and be like, oh yeah, that's reasonable. They're going to say, what the heck? Like, what are these guys trying to do? And so, of course, he researches and finds contradictory evidence, not uncommon, and says it's 500. And that's what he said his argument was. So let's go down. Let's see what I want to point out here. Okay, so a lot of this came down to support. They're saying they didn't present written documentation like minutes, agendas, calendars, all of that to substantiate. Testimony was inconsistent. And here we go. Here's that they deducted $290,000 in rent over the 3 years. And that was, to save tax. And so, of course, what does this seem like? Well, what it seemed like to the revenue agent and to a tax court was that it was a tax saving scheme to distribute the earnings, take a deduction and then not recognize the income. So that is the result that ended up happening for them. Okay, so some takeaways from this case. First thing is just don't go too, if you're going to utilize a tax strategy, I wouldn't go overboard with it. And then if you are going to take a strong position, or even if you're not, you want the support. And that's always something that I like to highlight a lot. I think people say, well, my CPA told me to do it, or my accountant told me to do it. But the reality is you're going to be the one holding the bag. Even if your accountant is responsible, it's going to be you and your accountant, not just your accountant. And so you're still going to be held responsible. And you always need support when it comes to the IRS. So that's going to be always the most crucial part, which is the burden is on you. It's guilty until proven innocent. So when the IRS comes in, if they see something they don't like, or even if they don't mind it, they can just deny it, and then you prove the alternative. And so just remembering that the responsibility is always on you. And then finally, I always view it as this goes back to implementation, right? So if you're going to do it, hire someone to do the implementation. That's the hard part. It's not coming up with the ideas. It's making sure the ideas are executed properly. Those are my 3 points. This is similar to whenever you're dealing with anything with the IRS. You want to make sure it's done right.